Welcome to the Fear and Greed Daily Interview. I'm Sean Aylmer. Share markets have certainly had a volatile start to 2022, and a lot of the movement has come in tech stocks. I wanted to find out today what the outlook is for the sector in the coming months. Elise Kennedy is the Vice President of Equity Research at Jarden. Elise, welcome back to Fear and Greed.
Thanks for having me again.
What a time to be following tech stocks. They've been hammered.
It certainly has been an interesting start and an interesting end to last year too.
Yeah. So I want to talk about the Australian stock, but let's just go to the US first. Some of the really big names, Apple, Microsoft, Netflix, they really have lost a lot of ground. Why?
Look, the reason that we look at is around the rate hikes and the moves in the sentiment, not even the actual rate hikes. So you might have heard these terms, hawkish, meaning, more advocate of a monetary policy that raises rates, or more of a dovish stance, which is, lower interest rates. Right now, they're talking more hawkish. So why this matters and how this flows through to, why you're seeing these tech stocks, especially in the US, sell off, has got to do with how it impacts your valuation. So I won't get too technical. I'll hold off doing that. But essentially, in short, the way that you try and price a share price has to do with this discounted cash flow method or other free cash flow methods that you time weight money using interest rates. And the higher that rate is, the lower the valuation. So as you start to see interest rates go up, all else equal, it means that a lot of those valuations are going to start to fall, especially those tech stocks where a lot of that valuation is later weighted versus those that, might be making some profits.
Okay, so I kind of get that sort of future expectations of earnings relies on a discount rate, which is an interest rate. What about the whole concept that the last 2 years we've spent so much money on technology, consumers have, that perhaps that has peaked? It'll still grow, right? But the growth rate has peaked simply because we'll start going out to restaurants and doing other things.
I think there's some stocks that perhaps, yes, were inflated. Take Zoom for a point in case on there. Has it been oversold though, and are we still using Zoom today? I think that's yes. So some of them, it may have pulled back too much, but there are, you think about it, some of the things that have accelerated the adoption curve, which aren't necessarily going to stop just because you're going to a restaurant. That's like saying, are you using a mobile phone, and just because you go to a restaurant, oh no, we're going to take back that adoption of the technology. So I think in some cases, that's the key point, is recognizing which of those stocks out there are discounted right now and have fallen due to a change in the near-term heightened demand versus those that are still actually going to see that demand even as the economy starts to reopen.
Okay, so how closely does the local tech sector on the ASX follow Wall Street?
I looked at this actually closely more recently because for a while, about 6 months last year, the correlation, which essentially is the closeness of the moves between the two, was about 0.5 or about half. So it wasn't really that closely aligned. But the last 3 months, and even more so the last month, that's changed. So right now, you're seeing a very strong relationship between the two indices. So in the last month, for example, if I look at what the NASDAQ 100, that was down about 18%, probably even more after the more recent fours. Yep. And then the ASX Tech Index was down about 16%. So they're getting increasingly aligned, I think, again, because we're seeing the inflations flow through in Australia as well. And we are privy to the US rate hikes as well from a funding mechanism for the companies we have here too.
Okay, so broadly speaking, if the Reserve Bank in the next few months comes out and indicates it's going to lift rates and actually lifts rates later in the year, that expectation will potentially hurt the valuations of the local stocks as well, or has that already been built in?
That's the really interesting thing, is you can follow the expectations, and that's really what moves the market often more so than exactly when they are going to hike. But from a sentiment standpoint, it tends to still have a reaction because, it's not 100% priced in. It's like there's a probability weighting of how many analysts or how many people are forecasting that to come through. So I think it'll probably still have an impact. But again, a lot of those fours have already started to be put through. That on the flip side, if they were actually more dovish, then I think you'd have the reverse scenario transpire.
Okay, so let's get into some of the local stocks. Let's go to the buy now, pay later sector first. I suppose we can't really talk about Afterpay anymore as a local stock because it's effectively reflects Square, its acquirer, which should happen in the next couple of months. But what about the others, Zip, Sezzle, those sorts of companies?
Yeah, so I think what's really interesting in the space as a whole is the industry consolidation. I recall when we, started looking at these stocks not too long ago, a year or two ago, we forecast that, it would take maybe 3, 4, 5 years till we started to look at industry consolidation. But right now, that's what we're seeing in the space with continued takeover talks. And I think that's because we've seen accelerated competition with the likes of, as you mentioned, Afterpay moving into a bigger likes of Square. We're seeing over in the US, you're going to potentially see a few more of the unlisted buy now, pay later guys like Klarna that came and had a relationship with CBA come through. So I think this year it's less now about just buy now, pay later. That was very last year. I think now moving forward, it's about how is the ecosystem of finance coming through and where can you see synergies between brands, both from a cost and revenue side, to be able to build out that ecosystem. So I think that's going to be an interesting space to watch this year.
Do you think the sort of spectre of regulation will hang over that sector?
I do think it will. As things in this space become, more meaningful as in terms in at least ANZ as a consumer finance, regulation is an important factor that needs to be always considered and I think is going to continue to be a preeminent discussion point and weighing on some of these types of names.
Stay with me, Elise. We'll be back in a minute. My guest today is Elise Kennedy, Vice President of Equity Research at Jarden. Okay, what about Seek, the recruitment company? We are seeing a booming jobs market here, though it obviously relies not just on Australia, but outside Australia as well. How do you think it will play throughout the year?
See, I really think this is an interesting stock. As you mentioned, not only is recruitment at all-time highs, but Seek has changed its business model where it's now leveraged to the difficulty of recruitment. So, for example, if you previously had a job as a barista or versus a banker, you'd be putting up that ad for the same price, whereas they changed their business model where now it's a matter of, hey, you might have to pay more if you're recruiting for a banker versus a barista, just more so based on, say, the location and or the pay rate that they're going to have. So that, again, in an environment right now where recruiters and the tech drain that we're seeing, it's becoming harder to come through. And there's some data that's being published on that more recently that even in the US, there's been this whole drain and this churn and Seek's completely leveraged to that. So I think that's a really important play on the thematics that might start to come through and be seen this year as, again, the economy starts to open.
Okay, what about the housing stocks? REA Domain Holdings Group, they're very leveraged to the housing cycle, which incredible run last year. I suppose most market economists still think prices will rise this year, though might come off next year. How does that play out for those stocks?
So I think that's the thing. In the near term, those thematics of house price increases bring listings volumes in, which brings in the dollars for these guys. Yeah. But eventually, as you say, we've all forecasting that perhaps next year that music will stop. So I think they've got a little bit more there to run, but it'll be interesting to see how they're going to fill that gap. Because once you've started doing, so well in terms of your numbers, you're cycling a harder comp. And then again, that means how do I continue to get those same dollars that I did in a different form or means?
Okay, what about carsales.com? Because that's very leveraged to the car market, and certainly the used car market's been very strong, or was in 2021.
Yeah, so everybody went and got another second car when COVID hit. But a lot of that, I think, has started to transpire and been through. Whereas now it's a matter of, do I really need that second car? And their business model from a revenue standpoint, how they make their dollars is leads, not just a listing. So it's more demand orientated. So it's when you and I are looking for our second or third car, and that's how they're going to get their dollars. Whereas if we started to drop off on that side, they're not likely to make as much. So I'm not as optimistic about them. I think management's fantastic. I really like the team. I like a lot of the, new things that they're doing around selecting your car from your couch. But I think that takes investment. So I think the two things there are, one, more investment, two, a slowing environment, that for me, it's hard to recommend that name.
Yeah, it's interesting. And car sales, Seek is the other one you mentioned there. It's kind of about innovative management in a way, that when cycles change, the ability to actually change and go with the market is really important for these stocks.
Absolutely. And that's what's really interesting and always hard because, Seek and car sales, the way that they came through was more as the innovator, and that was against some of the newspaper names. But now they're in a position as more so the mainstream go-to for them. It's like, how do I continue to innovate when I now am basically looking over my shoulder? But again, it comes down to management. The guys have been exceptional, I think, on that side around being able to try and reinvent yourself. And if I go back to Seek as well, they've been investing in a growth fund, which is all these startup VCs. So it's like, even if I can't do it myself, I'm going to put my foot in the door as to perhaps companies that might be my future competitors. So at least I'm leveraged to their capability to be able to be on that bandwagon rather than be beaten by them.
Okay, before you go, Elise, a couple which we've watched over the last couple of years in awe, in a sense, that they have pulled back somewhat, Xero and then WiseTech Global. They're sort of companies which many of us thought very little about. They're now top 20, top 30 companies because of what's gone on over the last couple of years. Can that continue? Let's take Xero first.
I think this goes back to how we started our conversation about the fundamental adoption of software, and is that going to change if the economy opens? And Xero, again, it's small business software. It's pulled back in share price. But at the end of the day, more and more businesses should be created when we open the economy. New businesses as well. Perhaps some haven't fared so well, and they're going to have some form of accounting software. They're not going to go and get a desktop software. So it actually is a beneficiary, if anything, of a booming economy. So that's where, for me, it's still a top pick. And I think that's an important fundamental there. WiseTech, so that again has been leveraged to the supply chain constraints, because any way that you can get items faster and track them and speed to market is ever more important in the environment we've had. Those guys as well are cash flow positive, which, as we discussed, tends to bode better in a higher interest rate environment. So that's where they've held up a bit better. But once again, those shifting fundamentals have continued, and valuation has now started to pull back. It was getting pretty lofty there. That, I think that's, again, a name where you think, well, has anything really changed when the economy opens? Not necessarily.
Okay. So I think where we're landing, and to all listeners, get financial advice. We're not a financial advice show, but get financial advice. But Elise Kennedy from Jarden, you're a bit of a fan of Seek and you're a bit of a fan of Xero, and you don't mind WiseTech Global either.
That's right. I'll have to tell you some sales next time. So it's not all price.
Next time around. Thank you for talking to Fear and Greed.
Thanks for having me on the show.
That was Elise Kennedy, Vice President of Equity Research at Jarden. This is a Fear and Greed Daily Interview. Join me every morning for the full Fear and Greed podcast with all the business news you need to know. I'm Sean Aylmer. Enjoy your day.